Governments across Asia and the G7 moved urgently on Monday to mitigate the economic fallout from the escalating Iran war, which sent oil prices surging as much as 25% after key producers cut output. South Korea, reliant on Middle East imports for 70% of its oil, capped fuel prices for the first time in nearly 3 decades, warning against panic buying, while Japan prepared national reserves for a potential crude release, though no financial decision was made. Other measures to ease energy pressures included Vietnam removing fuel import tariffs, Bangladesh shutting universities to conserve electricity and fuel, and China ordering refiners to halt exports and cancel committed shipments. The G7 finance ministers are expected to discuss a coordinated release of emergency oil reserves, reflecting growing international concern over disruptions to global supply chains and inflationary pressures on economies heavily dependent on oil from the Persian Gulf. Well, and for more on this, I have joining me on the line from New York, Ciollo, the executive editor and author of First Street newsletter at Business Insider. Joe, I hope I got the surname correct. Glad to have you.
You did.
All right. Well done. Well, let's start this discussion this way. How damaging or otherwise has this war been on the stock market? $6 billion wiped out in stocks. Japan's Nikkei 225 plunges. How damaging?
Yeah, it's been very damaging. And the main reason is because of the price of oil spiking so much. You mentioned that crude oil was up almost as much as 20% overnight. And that's an enormous strain on not just the oil market, but all markets. And really what's happening is as oil prices rise, people are starting to price in the fact that inflation is going to rise in other areas and that things are just going to get more expensive. And that's seen as bad for the economy, which then pulls back on stocks. So since the start of the Iran war, about 2 weeks ago, we've seen a fairly large decline in stocks, kind of the opposite of the increase in oil.
While the G7 finance ministers plan to meet today, Monday, to discuss the potential joint release of strategic oil reserves, Asian and European markets plunged while oil futures surged. Trump dismisses concerns, calling soaring oil cost a very small price to pay. What's your sense?
Yeah, I mean, I think that a lot of these the international governments have the ability to tap oil reserves. The U.S. also have oil reserves, but they've not expressed interest in tapping those quite yet. I think that I think, of course, Trump is going to say that, but he has proven himself to be sensitive to dislocations in markets previously with his tariffs, which is not the same situation. But with tariffs, he did a few times kind of walk back things that disrupted markets. And that's not easy to do in a wartime situation with a bunch of moving pieces in the Middle East. And so if he does decide that he wants to try to rein this in, he might find that it's gone too far. And I think that's the worry, is that this is not exactly something that you can just reverse with a post on social media. There are troops on the ground, there are oil tankers sitting idle, and there's just a lot of uncertainty. So, I think there's a lot of concern that the oil prices are going to continue rising.
Yeah, just like you said, it's not a social media matter. It's gone beyond that now. And Doug Brooks, I just interviewed him a while ago, saying that the issue here is that it may not just stop unless Trump finds a way to save face. And we watch and see how that plays out. Well, oil has surged $100. You mentioned that a while ago per barrel, a 4-year high. How is this impacting the oil and gas sector of the world's economies?
Right. So it's good for companies that drill oil or produce oil because it's pushing the price up, but it's bad for basically everyone else. It's bad for the planes, anyone that's trying to fly either passenger planes or cargo planes. It's just bad for the global infrastructure network. It's bad for trucks. It's not good for civilians driving from one place to another. And it also, like I mentioned, as oil at the pump gets more expensive, then then people are going to maybe cut back spending in other areas that are less essential as they adjust to that. So it's been pretty difficult, and it's not just a Middle Eastern focused issue. It's not just the U.S. because the U.S. is the most actively engaged in the Middle East. It's everyone. It's anyone that relies on that region for oil, and the Strait of Hormuz, which has been basically closed since the war started. That's about 20% of global crude that goes through there every day. That's not going through there. So we're seeing the fallout of that very, very starkly across the globe.
Yeah, very stark indeed. What do you make of the IMF chief's warning of global inflation risks? She also said, when she says prepare for the unthinkable, is that a doomsday
Mm-hmm.
prophecy, or what message is she passing to policymakers?
Yeah, I think it's a totally valid concern. I think that she's hedged a little bit, saying like prepare for it, so it might not actually happen. But yeah, I mean, I think that when it comes to things like this, like knowing what the risks are and knowing what the downside is, can actually help prevent more pain up front because people are more cautious. They're realizing that it's happening as it's happening, so they can maybe adjust their behavior. But when it comes to things that are so much out of our control, whether it's military action in the Middle East or what oil companies are doing, then yeah, it's hard to not feel hopeless sometimes as the consumer. And yeah, I think that what I keep hearing from people on Wall Street is not that like tomorrow something terrible is going to happen with the economy, but it's that if this disruption lasts for months to come, then that's in the cumulative effect of it and is going to just be worse and worse. So the U.S. hasn't really signaled that it's going to dial back at all, and they're continuing to operate on the ground in Iran. So it's anyone's guess when any pressure, if any, is going to come to us.
How do you see or evaluate the likely behavior of investors? Will they be shifting to safe havens for example, moving capital into gold or defensive
Mhm.
assets?
Yeah, I think that's going to happen. It's definitely been happening. Gold is a little bit of a strange case because it rose so much in the second half of 2025 that it's already so expensive that other people are turning to more defensive assets like the US dollar, the Japanese yen, the Swiss franc are that's kind of the holy trinity of safe currencies. And then within domestic stock markets, whether it's the US or anywhere else globally, people are rotating into like the sectors that are viewed as more as safer. So defensive stocks, energy stocks, REITs, real estate, not tech, not the big high flying companies that have been leading the market recently. So that's the state of play right now.
Yeah, you talked about uh, uh, the IMF chief warning, prepare. It's one thing to give that warning, prepare, but how do you expect policymakers? What would preparation mean? Because the whole arena is strewn with uncertainty. I mean, just 10 days into the war, thereabout, but so much uncertainty going forward. So, what will preparation mean from your viewpoint, from your, I don't know what to call it, crystal ball, from where you are, from what you're seeing?
Mm-hmm. Yeah. So in terms of what central banks or what governments can do, one of the main ones is tap the strategic oil reserves that you referenced, and that's kind of seen as like an absolute last ditch effort to keep oil prices contained, and that appears to be kind of where we're at. This is one of the biggest oil shocks we've had in decades, and then beyond that, I think when it comes to what a central bank can do to fight inflation, they can raise rates, they can raise interest rates. That's the best tools for fighting inflation. But the problem with raising interest rates is that it kind of chokes off economic growth because borrowing, lending gets more expensive, and it just kind of clamps down on the free flow of capital. So it's sort of, there's no really good answer. There's no one size fits all. If you do one thing, it's going to create an issue somewhere else. So those are the main policy tools that people have. But the main policy tool, if you can really call it that, is if we want markets to stabilize, is going to be a de-escalation of what's happening in Iran, and it's anyone's guess if and when that will happen.
It's anyone's guess. Joe, surely, thank you so much, Executive Director, editor
Thank you.
rather, and author of First Trade newsletter at Business Insider. Thank you for your time on the world on Arise News.